tell me a little about yourself, what you're doing right now.
Sir, currently I am working in a renewable company as a supply chain manager, and
Okay.
I'm looking after the procurement for the global procurement and the domestic procurement for them. So this is my, and I'm electrical engineer 2008 batch pass out. So
Okay.
total experience is almost 15 years in different industries,
Excellent.
construction. Yes.
So fine. I hope you've had a chance to look at some of the videos that have been uploaded. No? I don't know
Yes,
whether
sir. I got some chances, sir. Capital budgeting and all. So I
you,
have gone through a few, but not complete, sir. So
no problem, no problem. See, since for you, those of you who have joined for that advanced general management course, and those of you who are there for a very short while with us,
yes, yes.
most of these lectures which you will find in the record, what I have done for you people, that those lectures you will find are very they're like it's not a very detailed treatment. I've tried to simplify most of the things and try to give you an idea so that it will build up awareness about these different topics. So if we talk about, let's say, capital budgeting, you will have an idea now about what capital budgeting really means. If you are not familiar with this topic, then the word capital budgeting, it sounds very complex. What can this be?
Yes.
Once you begin to understand, it becomes easier. Now, today's topic is once again a topic which is something which you will find that you have definitely, you will be aware of this. There's no problem. It's financial accounting. So there's no question of not being aware of this. You're definitely aware of this. And what I hope to do today is take you through the basics of financial accounting and exactly as let's say a layman, someone who's an electrical engineer, who aren't familiar with this whole area, I'll try to show you what this subject really is and why it is important. Okay, so let me just जसप्रीत, आपके लिए ये थोड़ा हो सकता है कि repetitive हो जाए और it may not be very useful for you because you have a commerce background. But what I will suggest is that any point, if you want to add anything to the discussion, please do that. So together, together we will help Dheeraj ji to understand this whole subject better. Okay?
Definitely.
So now I'm starting with financial statements. So let's just take this quickly. So, ultimately, the way a company is functioning, what exactly it is doing, what sales it is making, whether it is making a profit or not, whether it is creating assets, what is the financial size of this company. If anybody wants to understand this, you will have to have some basic idea about what financial statements are. Now, everybody who has some stake in the company, whether he's a lender to the company, he's a creditor, whether he's a borrower, anyone, the customer, every person who is connected with the company would like to know whether this company is actually doing its job properly. For example, a shareholder wants to know about the earning figures. If you buy shares in this company, then definitely you want to know whether this company is making profit and what are its future prospects. You imagine a company in which there are many employees and the employees have a trade union. In that case, the trade union will want to know all about the financial performance. It will help them to make their demands for wage increases and things like that accordingly. They may want more welfare schemes, and if they see that the company is doing well, then they will naturally put pressure on the management to give them a share of the profits. But for that, they need to look at the statement and understand. So I live in a senior citizen colony here, and it is run by a company. The maintenance work is run by a company. So I often go and insist that show me your financial statements so that I understand whether you are using the money that you collect from us in a proper way. So every stakeholder basically has you can read this in some detail here, but for the moment, please understand, every stakeholder of the company would like to see the financial statements so that he has an awareness of what the company is doing. Now, there are a few things here, some key words. For example, the word expenditure and the word expense. We use this interchangeably. But if you look at this in a little, from the point of view of a financial accounting class, then I have to tell you the difference between the two. So you take expenditure in expenses, for example. Profit is income minus expenses, not expenditure. One simple way of understanding is, we say a company has this much income, it has so much expenses. So what income minus the expenses, whatever is left is the profit. This is the simplest way of understanding it. Now, expenditure covers the money spent on creating assets. Now, what assets are there? Like, for example, you're an electrical engineer. Let's say that you work in a company and the company gets machines. It buys some capital goods. And these capital goods, let's say, are used for making electrical appliances. And let's say you have a role somewhere in checking the quality of the products and things like that. Now, the money which is spent on buying those machines, that money is that you can call expenditure on assets. That is like expenditure for items that are used. But day-to-day expenses, day-to-day expenses on small things which are consumed. For example, raw material is consumed in a factory. Salaries are paid to the workers. These are all different expenses. Rent is paid. Electricity bills are paid. Telecom expenses are paid. Insurance is paid. These are all expenses. These are referred to as expenses. That is, anything spent on consumption items, you think of as an expense. And something which is expenditure will also, expenditure is getting divided into two parts. One part of expenditure is expenses. Another part of expenditure is the money which goes into the creation of assets. This is not treated as an expense for one reason. Asset is not consumed. You see, when you buy a machine, that machine will be used to produce goods, maybe for 5 years, 6 years, 7 years. That machine has a role to play in your company. So it is very different from, let's say, the expenditure which you make on buying chairs and tables and things like that. That's just consumption expenditure, or the expenditure on petrol for a car. So one difference is here. Another thing which you should understand is the difference between liabilities and assets. So when we say balance sheet.
So just a question, a small thing. So regarding, suppose a company is working and they are putting some money into the R&D, okay, research and development, and that research is being considered an assets, or once it is, suppose they...
No, not like that. There are many parts to it. See, the research, the equipment which is bought for that research, that will be asset. The money which is paid to the researcher as his salary, that is an expense.
Okay, so different parts are there. Okay, sir.
Like that. So, in a balance sheet, there are two parts. There are liabilities and there are assets. Now, liabilities in accounting means basically just a minute, let me show it to you. Sorry. Liabilities in a balance. Where do you get the money to run your company? That is a liability. Why? Because it has to be paid back. For example, you can get the money from a shareholder. Therefore, when the shareholder gives you money and you call it shareholder's capital, this capital is a liability for you. Why is it a liability? It appears, counterintuitive. Why should this be a liability? Because when we use the word liability, generally we take it in a negative way. In accounting, it is not a negative thing. It is just trying to understand liability is a source of funds. Now, when a shareholder gives you money, you use that money to run the company. The money that you take from him has to be repaid to him in some form or the other. You will give him dividends maybe. That could be one way. Now, this is why it is a liability. If you close the company, you will have to return that money to him. Now, if a banker gives you a loan, that is a liability for your company. You are using the money that the banker has given you for the purpose of running your company, but you will have to return that money to the banker. Therefore, it is a liability. So the liability refers to the sources of funds, and the assets refer to the application of funds. That is, what did you do with the money that you got? These people gave you funds. How was it used? So you used it to create assets. Therefore, the assets are application of funds. Liabilities are the sources of funds. Now, these two will appear in the balance sheet. In the profit and loss account, you will have two heads: income, expenses. Income generally for a company refers to sales. Any revenue which the company receives from the sale of its products or services is considered to be income. And all the expenses that it incurs, the salary, the rent, the other overheads, all that is expenses. Now, so the balance sheet is made on the last day of the financial year. And it represents the position of assets and liabilities on the last day only. If the balance sheet is something which is a historic statement, it is locked on that day. So it is applicable only for that particular day on which it is made. If you look at the balance sheet of the company one day after that, some transaction may have taken place and there will be some minor change. So you have to understand that the balance sheet is basically made as on one day. That's one point to remember. So when we say assets, just looking at it in a little more detail, assets are resources that help the company to generate revenue in the future. So if you buy a machine, or let's say you're a service company, you buy computers, servers, that sort of thing, which helps you to run your business. These things will help you to deliver services. The machines will help you to produce goods. And those things will ultimately be sold, the goods or the services, and that will help to generate revenue. Now, examples of assets, think of what you can, what can you think of as examples of assets? Basically, think of all the things that will help you to generate revenue. So think of machines, think of equipment, that sort of thing. Anything in that range, you think of it like that. Now, that is one part. Now, the other side, just a minute. The other side, liabilities are, like I told you, they are the sources of funds. It represents an obligation to repay money or render services in the future. So if you accept, why render services in the future? Suppose you have received money from someone as an advance for a service which you have to give. Let's say that you are a company which is providing certain software services. And this customer gives you 5 lakh rupees as an advance. It is expected that the total bill will be about 20 lakhs. They give you 5 lakh rupees as an advance. Now, when you receive this money, it becomes a liability for you. Why is it a liability? Because there is an obligation that you must repay this money to the customer. Therefore, it's a liability. And since you have received money, like I said, it is also a source of funds. You have the money, you will be using that money. So it's a source of funds for you also. So source of funds and an obligation to repay. Assets, resources are created from the liabilities with the objective of using the assets to basically create goods or services which can then be sold to generate revenue. So this is a little thing which you can think about. Examples of assets and liabilities. Now, here is a balance sheet. Like I said, liabilities are sources of funds, assets, application of funds. Here is your first liability on any balance sheet, capital, equity capital. This is the money which the shareholders have contributed. In return, they have been given shares of the company. So this share which they have been given, those are equity shares. So their ownership of the company is up to the extent of number of shares that they have bought in the company. So in this example, I'm saying, let's say these people have contributed 500, let's say lakhs to the company by way of capital. So the company has taken this money and it will use this money to build up its company. Apart from this, the company has also borrowed money, 1,000 lakhs, from some bank maybe. And these borrowings are also a source of capital for the company. Now, company has these long-term funds. There is no obligation on the part of the company to immediately repay this. The shareholders will be repaid in due course through dividends. No shareholder can come and sell his shares back to the company. Because he can only sell his share to someone else who is interested in that company and wants to buy a share. So that is what happens in the share market. People who have shares, they want to sell the shares. People, who will they sell it to? Another group of people who want to buy the shares that they have. And depending on the demand and supply between those who want to sell and those who want to buy, the price of the share is decided. That is something which is beyond our, the purview of this class. But that is what happens in the share market. Now, the point I'm trying to make to you is that a person who has shares does not have, he cannot expect that the company will buy these shares back. That will never happen. So when the company gets shares, those shares are a stable source of funds to it. In the case of borrowings, whatever the company gets, there is a certain condition attached. For example, if it takes money from a bank, the bank will say that this money should be returned to me in the next 5 years, in the next 7 years, in the next 10 years. So within that period, the company has to repay. And in what frequency should it repay? The bank will decide that. How much has to be paid? What is the rate of interest? So the borrowings, the obligation here is to repay. So please understand this. In the case of shares, they don't have to immediately buy back the share from the shareholder if he wants to sell. But in case tomorrow they want to wind up the company, then there will be an obligation for the company to repay the shareholder. Now, other liabilities which are there are this cash credit, which is like a overdraft account, which the bank gives to a company. So let's say it's 40 lakhs. That basically means that the company can draw money up to 40 lakhs and it will keep depositing money as it sells goods. Then as it deposits money, the balance will go down from 40. Let's say it goes down to say 30. Up to 40 they can take. It goes down to 30. The remaining 10 they can take again. So there is no restriction on taking money again and again. So it's like an overdrawing account. Like for example, if you open an account with the bank and they give you an overdraft, then that overdraft account is something which is a running account. You can keep depositing money, you can taking money, and this can be done any number of times. So this cash credit is like that. Source of
So
fund.
just a question on cash credit. Sir, this 40 is the limit for the means doing the business with the bank or something, overdraft limit. But that exact number will not come in the liability, na, sir. Suppose I have taken as a company, I have used only 30 lakhs in a certain year.
Then only 30 will come.
Okay. Okay.
In this example, I am assuming that the amount they have taken from the bank is 40. But you are right. In case they have taken
as per the actual,
that
it will be as per
as on 31st March, whatever the amount was, that amount.
Yeah.
Then they may have bought some goods on credit. They may have bought some goods on credit and they are required to pay these bills in the future. So let's say that is another source of fund. Let's say there's 5 lakhs of that. Company bought something, it hasn't paid yet. Because in business, it is very common to have a period of credit. Every seller will give, for bulk purchases, they are happy to give a period of credit if the basic reputation of the buyer is okay. If that is okay, then that's fine. So there will be many such payables. Lots of payables will be there. And let's say in this particular example, the total of that is 5. Then taxes are also payable. No? You have to pay taxes. So that is another, let's say it is expected that you will have to pay. You have not paid yet. So you basically show that also in the balance sheet. Now, salaries, let's say for the last month are payable. You are making it in March. Let's say 50 lakhs of salaries for the month of March is payable, which you have not paid on 31st March, but you will have to pay in April. Then that amount will come here. Interest payable, you have taken a loan from the bank. This cash credit is here. Let's say you have to pay this 10 lakhs as interest. If this is interest which you have to pay, then this amount will be paid in the next month. But as on 31st March, it will appear on your balance sheet as a payable in the liability side. Rent payable for the month, let us say it is 5. You have to pay. You haven't paid yet. So it is a liability. Dividends payable. You have to pay, you haven't paid. So that, just remember this, the logic is, if there is something which has to be paid by you, then that will appear on the balance sheet on the day it is prepared. Next day you paid, it will change. The situation will change. But on that last day, any money that you are required to pay anyone has to be shown in the balance sheet as a liability. So like I said, a liability, in the case of a liability, there will always be an obligation to repay. Now, the assets typically will be land and buildings. This is how you have used this money, machinery, office equipment and furniture. If you take some of that money and you invest that money in some other company, even that will be an asset for you. Only difference is that it is a financial asset. Why is it an asset? Because when you invest the money in a different company, that company is again obliged to give you something in return for that. So you may be receiving dividends from them, you may be receiving interest from them, something will be receivable by you. So it is an asset. It is earning money. Then the short-term assets are current assets. So there is cash lying in the bank as on 31st March. Inventory. So you may have bought different items, raw materials, stock, whatever. So that will appear. Bills receivable. Maybe you have sold services or goods on credit. Just like you receive credit, you also give credit. So if you have done that, then in that case, those are bills receivable. So you will be receiving this money in due course. In credit, when you give credit to someone, basically what happens is that you have you will tell them that I expect to receive the payment in the next 30 days, 40 days, 45 days, whatever, and they will pay you. As on 31st March, it is still receivable. You have not received it yet, so it is 200. Tax refund receivable. If there's a case like that, it will also appear under the asset side because you are going to receive this money. Okay, so this is the next part is these two will always tally. There cannot be a situation where these will not tally. They will always tally. Because basically, whatever you get, only that you can spend. See, where can you get money from? Either somebody invests with you, in which case it will appear here, or you borrow from someone, it will be here, or you borrow short term, in which case it is here. So, and these again, since these are in a way you are borrowing, now people have worked in your company, they have provided you services for which you have to pay them. So all those liabilities appear here, the assets appear here. This is the basic concept in a balance sheet. Now, look at the profit and loss account. This is also known as the income statement. Income or revenue is the amount of income generated by the business. The sales figure of a company is shown as income. For a manufacturing company, the sales of its goods will generate income. For a software company, the sales proceeds of software programs, license fees for using the software, that will be income. So some sale has to take place. Now, the sale can be of goods, the sale can be of services. If there is a hospital, it is taking, let's say, fees from patients for the services that it provides. That is the sales for the hospital or the revenue for the hospital. So the word revenue and the word sales, both of these should generally be, you hear these words, you should think of income. Because these are cash receipts for the company. Company like Reliance Mart, the sale proceeds of the goods that it stocks, that is the revenue for Reliance Mart. And please remember, income is not profit. Income is money which you have received. Profit will be after you have provided for, you have deducted the expenses. Expenses have to be deducted. Okay, so this distinction has to be there. Another thing here, if you have taken part of the money that you have received and you have used that to buy an asset, that transaction does not appear in the income statement. That will only appear in the balance sheet. In this statement, in the income statement or the profit and loss statement, only the expenses incurred on manufacturing the goods or services and the income from the sales of those goods and services, only that is reflected. Now, expenses on day-to-day operating expenses are recorded in the profit and loss statement. See, we are not talking about assets here. Any money spent on buying assets, that is not going to come here at all. Now, what will the profit and loss statement look like? It looks something like this. First thing to remember is, this is not prepared and it is not applicable to one day alone. It is for a period. A profit and loss statement, unlike the balance sheet, is basically for a certain period. The period is 1 year. In India, the accounting period is 1st April to 31st March. So the date here is going to be 31st March. But basically the transactions here, which you write, those represent the transactions which have taken place during the 12 months of that year. That is one important thing here. So sales figure is 10 lakhs. Cost of goods sold. So the cost of goods sold, that is the money which was expended on buying the goods. So remember here, you don't show it like the balance sheet, expenses this side, income that side, everything is going to come here. So the amount you spent on buying these, on let's say producing these goods which you sold is 6 lakhs. You sold it for 6 lakhs, for 10 lakhs. So the gross profit that you made is 4 lakhs. This is simple enough. Now, from this is not your final profit figure. Now you begin to minus the expenses. So let's say during the entire year, you spend 50,000 on rent. You spend 10,000 on electricity, 60,000 on salaries and wages, 20,000 on marketing, 10,000 on interest, 5,000 on depreciation, 5,000 on insurance, 1,000 on conveyance, and the total of this comes to 1,61,000. Then these are your operating expenses. So you have produced the goods for 6 lakhs. What are these expenses? This is only, you are bifurcating the expenses. Here you are showing only those expenses which are directly, let's say, direct, these are direct expenses which are incurred in the process of producing the goods or service. And here are the operating expenses. To run your business, you have to do these things. So these expenses come here. Now the actual profit that you make is this, 239,000. This 4 lakhs minus this 116,1. And this actually is your, this can be your net profit from the business. Now, I told you a company sometimes invests money in other companies. Now, imagine that in this particular case, they received interest on their investment in some other company of 51,000. This 51,000 will also be added to your net income or the net profit. And that is called, and then if you take these two and you total them, you get 2,90,000. But this 51 is shown separately because this 51 is not coming from the business. The business is contributing this 4 lakhs. But this is something which is shown here because the company has invested some of its funds in a different company for which it has received something. It's just a matter of understanding that the business is actually getting you 2,39,000. This investment of yours is getting you 51. Combined total of that is 2,90,000. And this is the net profit of the business. This is the basic.
So regarding this, suppose a company is getting 51,000 from the another company. So is it a mandate from the government to show it as a separate income, or can they add it to the sales or something?
No, it has to be shown as separate.
Okay.
It has to be shown as a non-operating income. See, the reason for that is that people who invest in this company, now they want to know the performance of this company. Okay, they don't want you to mix it up with investments. So you have clear?
Yeah, sir. Because in that company, it can happen a means loss or a benefit. That depends on that company performance.
Yes. So that is a separate issue. So therefore, you have to show it separately. But since you are getting money, the investment was in the name of your company. Therefore, the money, the interest which you received was received in the company's account. Therefore, it is shown here. So this is what a profit and loss statement actually looks like. This is number 2. Now, let us just spend a little now on understanding depreciation. See here, one of the things that we saw was depreciation we showed as an expenditure. So what is this depreciation? Now, suppose a company wants to purchase a machine that costs 10 lakhs. The life of the machine is 10 years, after which it has to be replaced. And the accounting for this is as follows. So initially, when the machine is bought, the machine account will be something like this. 10 lakhs machine, it is shown as a debit. Remember, assets are debits. Bank account, credit. Bank account, 10 lakh is going from the bank. 10 lakh is being put into the account of the fixed asset. So just like you and me have our personal accounts, every item on the balance sheet will also have its own account. So the first entry you make when you buy the machine is this. After that, what happens is, let's say after 1 year, it has a life, remember, of 10 years. So if I say that every year, let's say after 10 years, let's say the machine is now of no use. That means the total depreciation after 10 years is 10 lakhs. But if I spread this 10 lakhs over the last 10 years, then it means that it has depreciated 1 lakh every year. You get this?
Yes, sir. Means every year it is uniform depreciation of 1 lakh.
Of 1 lakh. Now this 1 lakh, the entry will be here. We started off with 10 lakhs as a debit entry. Therefore, the depreciation point here is shown as a credit entry. So 10 lakhs minus 1 lakh, the balance of this account will become 9 lakhs. And this 1 lakh is shown as an expense. So every year, all the assets will be depreciated and that will be shown as an expense. Now, what you need to understand here is this money is not leaving the company. But since you are treating it as an expense, your profit is coming down by that. Remember, income minus expense is profit. So if you show depreciation, that means your expenditure is increasing. So your profit is coming down. But why do you do this? Because when the time actually comes to replace that machine, you are able to have the funds for that replacement. Otherwise, if you don't do this, then after 10 years, when the machine needs a replacement, then in one go, you will spend 10 lakhs. So because of that, this has to be done. Now, it will look something like this. 10 lakhs here. First year 1 becomes 9. Second year 1, it becomes 8. This goes on. In the last 10th year, it becomes 0. Now, let's say the machine is still functioning. It is still worth something. It is still functioning. Then what normally is done is this 0 is actually, we don't write 0, we write 1. That means you will have whatever depreciation you are charging, you will reduce it by 1 rupee. So this will be, let's say, be 9,999. And the final balance will be 1. So that your books will show that this particular machine is still operational. That 1 will say, if you write 0, then there is a chance that machine will no longer figure in your books. It will get lost. In terms of accounting, it will get lost. So here, you will show this and it will be 1 rupee here. So this is how a depreciation account actually looks like. Now, so here is the impact on the profit. When depreciation is charged every year, the impact on the profit and loss account is proportionate. So it's like this. Gross profit is 5 lakhs. Expenses other than depreciation, the other operating expenses, let's say, are 2 lakhs. Depreciation is 1 lakh. Total expenses are 3 lakhs. Your net profit is 2 lakhs. This is what we were doing in the last page. Just as an example. So 1 lakh is depreciation. The other operating expenses was 2 lakhs. So let's say the total operating expenses of the company are 3 lakhs. Its gross profit was 5 lakhs. So 5 minus 3, it gets a profit of 2 lakhs. This is under when we are charging depreciation proportionately. But suppose you don't charge it proportionately. Suppose what you do is you charge it in the last year only. Then what will happen? When depreciation is charged in the last year, the profit and loss account of the company is impacted heavily by the total cost of the machine. In this example, the company goes into loss. So let's say the gross profit again is 5 lakhs, 10 years after. Expenses other than depreciation, let's say, is again 2 lakhs for that year. Depreciation, you have not charged anything in the earlier years. This year, you realize that the machine is now worthless. So you have to charge depreciation. So you charge 10 lakhs. Total expenses goes up to 12 lakhs. So your expenses now are 12 lakhs and your gross profit is 5 lakhs. So your net profit is now minus 7 lakhs. That means you have actually made a loss. This is the logic of charging depreciation every year. You spread it over the entire thing. Now the third statement, which this is clear, na, Dheeraj?
Yes, sir, it is clear, sir.
Yes. Now, so we have done 2 statements. We've seen balance sheet, we've seen profit and loss. Yes. Now look at the third one.
Sir, just one question on the last slide. Sir, in case suppose it's a big company, suppose 100,000 means 1,000 crores of a company. Instead of putting a depreciation of a 1 lakh rupees every year, they do 10 lakh in a 10th year. So will have an impact on that, or just a scenario?
It's not like that. It is the principle of the thing. Na?
Correct.
See, you have to follow a particular principle. It doesn't depend on your size. And the other thing is that this huge company that you're talking about may also run into a huge loss tomorrow. So,
the 10th year or something.
You don't know what will happen. Na? See, the principle is spread the depreciation equally over the life of the asset. Now, if you buy, let's say there is a computer. You buy, let's say, a laptop. Laptop is an asset. Now, the laptop may need replacement after 3 years only. In that case, if the laptop costs, let's say, 3 lakh rupees, let's say it's a very expensive laptop, it costs 3 lakhs and it has a life of 3 years. Then your depreciation for that will be 3 lakhs divided by 3. It will be 1 lakh. Because the life of the laptop itself is only 3 lakhs. So that is the principle you are using is, I will proportionately depreciate the asset over its life. So whatever is the life, you take the cost divided by the life, and that many years you depreciate it. Now,
and so one more point, sir, just once you have mentioned that you are putting a 1 rupee if it is not being consumed after 10 years, suppose it is still working. So suppose it works for next 5 years, just in a case, big machinery is there. We have estimated for 10 years and it is working for less 15 years. So every year you will put 1 rupees like this. It will roll over.
Remain 1. You will stop charging depreciation because see, this is you are actually in a very happy position here. You thought the life of the machine was 10 years. You spread the depreciation over 10 years. You reached the 0 point. You made it 1 rupee. After that, you will not have to charge any further depreciation.
It will remain same.
So you will get whatever you get from the machine from the 10th year onward. That is like a bonus for you. You think of it like that. Now, the third statement which we do is the cash flow statement. Now, the cash flow statement is slightly complex. Let me see if I can help you with this. So basically, what does it do? It explains the changes during the period, see, 1 year period, in cash and cash equivalents. So what this statement is talking about is only those transactions which resulted in cash either coming into the company or cash going out of the company. Always remember that when we say cash, we are actually referring to any receipt in the bank account or physical cash, both, anything. It just has to be a monetary receipt into the account of the company. It is considered cash. Now, why is this cash so important? Because see, if a company makes a lot of sales and it sells these things on credit, as far as the profit and loss account statement is concerned, maybe the company will show a very big profit. But if the buyers, the people who bought from the company, if they are not the customers of the company, if they do not pay up on time, let's say the goods were sold to them on credit and they don't return they don't repay the company on time, then what will happen? The company will show a profit on its books, but it will have no cash in the bank because no money is flowing in, no cash is actually flowing in. That is why it is a requirement that the company has to show the cash flow also. That is why this statement is made. Now, what does it do? It classifies the receipts and cash payments during the period in 3 forms: operating cash flow, investing or financing cash flow, and financing. So basically what happens here is operating activities, investing activities, financing activities. So cash related to operating activities will appear here. Cash related to investing activities will appear here. And cash related to financing activities will appear here. Now, when we say related to financing activities, what do we mean actually? We are saying only those transactions where cash came into the system, into the bank's, into the company's bank account because of a financing activity. That means it received credit from someone or it gave, let's say, made an investment somewhere or gave credit to someone. So look at this. Cash from operating activities will basically be inflows or receipts of cash on account of goods made or goods or services made by the company and sold. Cash from operating activities, payments of cash will relate to payments to suppliers, payments of all heads of operating expenses like rent, power, salaries, etc., what we were seeing. And investing activities are basically amounts paid for purchase of machines, equipment, amounts invested in a bond or share of another company. Sale of these assets will lead to an inflow. So remember, we said that cash outflow in a company can happen in 2 forms. In one form, it will be like an expense where you are paying, stuff like rent, power, salaries. That is one way. These are expenditures for consumables. The other way cash leaves the company is when you use it to buy a machine or an equipment. Now, from the company point of view, this is an investment. It is an investment because you are taking the funds of the company, you are putting it into a machine, and you're hoping the machine will pay back that money to you by producing goods that can be sold. So the ultimate purpose is I put the money in the machine produces goods, the goods are sold, and in this way the machine repays me for the investment that I made. The other investment can be that I take this money, I give it to another company, they give me a certificate, we have received money from you, and they repay that money to you over a period of time. They give you interest also, and they give you the money back when the term is complete. So the transaction, if you notice, is similar. You're putting money somewhere and that money is getting repaid to you. Therefore, both these are treated as investments. The third part is, these are all outflows. The inflow will be what? If you make an investment in a company, it gives you interest, that is an inflow of cash. What will be the inflow in the case of purchase of machines? Tomorrow, you sell that machine. Or let's say you invested in land, you sell that land. The money which comes in is a cash inflow, which is classified in this section, investing activities. So basically, everything which relates to your day-to-day operations, the running of the business, is classified here as an operating activity. And everything which relates to investing is classified here. And everything which relates to loans is classified here. So when you take a loan, it is an inflow for you, because the bank gives you the money. Remember, loan is a liability, obligation to repay, it is a source of funds. So it's an inflow. And when you repay the loan or you repay interest, it is an outflow. So that will appear in this section. Why do we do this? This whole concept of doing it in three parts? Because if you do it like this, anybody looking at the cash flow statement, they get a very clear idea about exactly what has happened here. Is this clear?
Sir, just so the operating and the financing will be correlated only. Na? Suppose I take more loans to increase my production. So my interest from the banks will increase. So it is a correlation of a kind of a thing.
No, see, it's like this. When the financing part, you will accept this, na, that the financing part is a separate thing. You are taking money from the bank. The objective is to use it in your business. That is okay. Now, when you begin to use it in your business by way of, let's say, payment to suppliers, let's say you take money from the bank, you use it to pay your suppliers, you use it to pay your rent, power, salaries, whatever it is. And then when these are sold, it will appear in the receipt section of the cash part. But your business is here. This is a source of fund.
So it will be separate only.
That's why it is shown as a separate thing.
Correct, sir.
Okay.
Yes, sir. Clear.
Now, how do I show this? So here is an example. Operating activities for the year ended 31st March 2021. So during the year, the company received in the last 12 months cash from customers to the extent of 10 lakhs. It paid cash to suppliers of 2 lakhs. It paid salaries of 1.5 lakhs. See, these are clear outflows. Money is going out of the company. Other operating expenses was 50,000. The net cash is 6 lakhs. How am I getting 6 lakhs? This comes to 4 lakhs. Total of this is 4 lakhs. There is 10 lakhs here. So net cash from operating activities is 6 lakhs. So this part of my cash flow statement will tell anybody looking at this that the company has actually received this money because they have got cash from customers of 10 lakhs. So this is not looking at sales made by you on credit. It's not interested in that. You may have sold the goods on credit, but during the course of the year, this money came to you. Are you getting this point? You may have sold the goods on credit. Let's say you sold it in May. By June, you received the money. You sold another batch in August. By September, you received the money. So at the end of the year, the total money which you actually received, which is reflected in your bank account, is 10 lakhs. And during the same period, you made all these payments to your suppliers. You paid salaries. Your other operating expenses were done. And these came to 4 lakhs. So you ended up with a net cash from operating activities of 6 lakhs. Now, investing activities. Let's say you sell some land. All the older companies, they have excess land. Some land is sold. You purchase some equipment of 6 lakhs. So what is the net cash now? You have sold land, you have received 5 lakhs. During the course of the year, you have also purchased some equipment, which comes to 6 lakhs. So basically, there is a net outflow of 1 lakh. Now, take the financing part here. You pay dividends. In your company, your shareholders had bought shares. You have to pay them dividends. So during the year, you paid 1 lakh as dividends. Now, you also repaid the loan of 50,000. So, the net cash from financing activities, there is nothing you have received. You have not received anything. So, this is again an outflow. So, what are the total outflows here? Here you find that it is 1 lakh. Here it is 1.5 after netting. And here the basic point is you have a surplus of 6. So ultimately, what is left with you? Basically, 6, 250, you are left with 350. See, this section, the net, the actual receipts where you gained something, where your bank account increased, is 6 lakhs. And here, this 6 minus 5 gave me 1. Here, this 10 lakh 50, this became, 1 lakh 50, nothing is received, so clear 150. So 250 here, 6 lakh minus this 250, it gives you 3 lakh 50. This 350 is the amount which has flowed into the business during the entire year. So now that when you look at this, it gives you a very clear idea about where the money has come from. See, when we showed the investing activity separately, it allowed us to immediately see that the company has got 5 lakhs from sale of land. This is not, they will not always have land to sell. This year they had land, which was, they had, let's say it was there in the company for a very long time. They had the land and they sold it. They sold the land, they got 5 lakhs. Next year, they won't have this. So next year, anybody who is a shareholder in this company, he will sort of take this into account. Maybe next year, the profits are going to be less. Because next year, the company won't be selling land. And the amount it is generating from its own operating activities is 6 lakhs. But this expense will always be there. So next year, maybe it will not purchase fresh equipment also. See, what I'm trying to tell you, Dheeraj, is that it is very possible that next year you are going to have a less of a profit because there will be no sale of land in this case. If the company again buys equipment in the next year and there is no sale of land, then the overall profit will be reduced. Now you are able to see this because the figures have been arranged in this form. If you mix this up, it will become difficult. That is the advantage of breaking it up into 3 sections. Okay. Now, those are the basics about those 3 major financial statements. Now, all those 3 statements that we talked about, all of them are mandatory reporting for the company. That means they have to prepare those balance sheets, profit and loss account, the cash outflow statement, and they have to publish this on their website. So for any publicly listed company, you will get this information every 3 months. At the end of every quarter, an audited balance sheet, profit and loss, and cash flow statement will be available on there, will be made available by the company on its website. So anybody can go and look. Those who have shares, who don't have shares, it doesn't matter. Anybody can go and look. They will also submit a copy of those statements to the registrar of companies. If it is trading on SEBI, it will submit it to SEBI. When it pays its income tax, it will use those particular statements for calculating its tax, and that will again be submitted to the tax authorities. And it will be presented at the annual general meeting of the company. So basically, all the shareholders will get a chance to see it and to discuss it. If you are intending to invest in the company, you have a chance of looking at these statements on the internet. How will you look at it? You go to a site called moneycontrol.com, find your company, ask for balance sheets. It will show you the balance sheets item by item in much more detail than I have shown you here. And though that, it will show you for the last 5 years. If you have the patience to look at it, you will get a very good idea about how this company has actually been performing during the last 5 years. So this is something which you need to keep in mind. If you understand the basics here, it makes it possible for you to actually look at these financial statements and come to your own conclusions about the performance of a company. Now, another way, now I'm talking about, getting into a slightly deeper level now. Let us say that we want to understand different types of companies. Look, I'll make this clear to you. Suppose instead of giving you the actual figure, let's say we said that the actual item amount is 50,000. Suppose instead of 50,000 of expenses, let's say salaries are 50,000, total expenses are 5 lakhs. Just an example. Another way I can show this is, I show the salaries as a percentage of the total expenses. So I say that salaries are 50,000, but as a percentage of 5 lakhs, it is 10%. I'll write 10% only. What am I saying? How does this help? It lets you know the breakup of the expenditure. How is the company, what is it actually spending on? What is the proportion in which it is spending on different heads of expenditure? In the balance sheet again, if I show everything as a percentage, once again, I begin to get an idea about what accounts for what. Just keep this in mind. The example will come and you will see what it is. So what we see in this type of statement, common size analysis, are not actual figures, but percentages. How does this help? So as an investor, let's say I want to compare different companies, and these different companies are absolutely different from each other in size, in the industry that they are in, all that. But I still want to make a comparison, try to understand. So how do I make everything in the same, like reducing everything to the same unit? I use percentage. Everything is reduced to a percentage. So in that case, it doesn't matter if I'm comparing an electrical, let's say, goods company with a paint company. The basic structure of its financial statements will become very clear, and it will be easy for us to understand. We'll come back to this, but let me just show you the example first. Here, taking an actual company here. Let's take Colgate Palmolive, and here is the balance sheet. So 2013, 2012. Now, this side these figures here are the actual figures. Okay. These figures are in millions. So Colgate-Palmolive on the 31st of March 2013, it had bank balances of 4,288 million. It had accounts receivable of 812 million. It had loans and advances it had given to other companies, when these are like they have given loans to someone else, of 977 million. They have inventories, that means stocks of goods, worth 1853 million. Has fixed assets of 3,826 million. Other assets of 1,311 million. And its total assets are 13,067 million. Now, if I want to introduce this as a percentage, what will I do? I will take all these and show it as a percentage of the total. Each of these figures, if I say cash and bank, what is the percentage of cash and bank of the total assets? So when you take 4,288 and you get the percentage out of the total assets of 13,067, what you will get is 32.82. That means almost 33% of the assets of Colgate-Palmolive for that year was in cash. This was actual liquid cash available with the company as on that year. Now see, the moment you do it like this, you are getting a better feel of the figure. It has assets, but these are not just any asset. A lot of it is actually just cash, which it can use for any purpose. The accounts receivable, that means goods which it has sold on credit, for which it has not received payment yet, that is only 6.21%. Loans and advances, the money which it has invested in other companies or given loans to other companies, that is 7.48%. Its inventories, stocks and all are 14.8%. So the total of its current assets, these are all the current assets. Out of the total, the current assets are 60.69%. Out of 13,067 million, 7,930, the total of these four, the total of these four is 7,930. These are the current assets of the company. So these current assets are equivalent to 60.69%. Fixed assets are almost 30%. Other assets are 10%. This is how the assets appear. This is the proportion under different items. Now, why do we show 2 years? It gives you an idea about each of these items. How did they get affected during that 1 year? What was the change? Was it a positive change? Was it a negative change? So the moment you do that, you begin to understand the performance of the company even better. So in this particular case, look at this. In 2012, they had about 27.43% of their assets in cash. This went up to 32.82. One way you can say it's a good thing this has happened. The amount of accounts receivable in 2012 was 9.64%. This has gone, 7.73%. This has gone down to 6.21% in 13. Once again, it's a positive thing. The number of people who owe money to the company and who still have to pay them for the goods that they have bought has gone down. Its loans and advances to other companies has gone down. This is not of particular interest to us. Inventories, you can see that 19.27% was locked up in inventory in 2012. that has gone down to 14.18%. Now, this is something you will very easily appreciate. If my inventories are coming down, that means I am successful in selling the goods that I have. It is easy for me to sell. When I'm not selling goods, they keep piling up. And when they keep piling up, that is a blockage of funds for me. I would much rather prefer that I have less inventory and more amount in cash. So here what we are seeing is that the inventory here is actually going down from 19.27% to 14.18%, and the cash is going up. So if you compare these 2 years, you can see very clearly that the company which was already doing so well in 2012 seems to have done even better in 2013. And when you look at it in these terms of percentages, it is easier to visualize what is happening. And the same thing is done for the liabilities side. Each of these items, like for example, accounts payable is 4,666. It is shown here as a percentage of the total liabilities. So the total liabilities here are 13,067 million. 4,666 as a percentage of this is 35.71%. That means...
Sir, in the above, sir, the current asset percentage is coming down from 64 to 60%. So is it a positive thing for a company? The current assets are there, na? It was 64%.
Right, but you should look at the composition. Na? See, okay. If you look at current assets and you see it is coming down, only on that basis, you cannot say anything. But if you want to make a comment on whether it's good or bad, you will look at the different items which compose the current assets. So yes. For you, what is important is you look at these items.
Account receivables.
Yes. And now you see each. And then it will become clear to you. You don't. Yes. So similarly here, when you come to the liability side, you get these percentages here. Once you get these percentages, if you compare it with the percentages for the last year, you begin to get an idea immediately about what is happening. So one thing you can see is that accounts payable, the company does not repay its creditors very easily. It allows a large, it takes longer to repay its creditors. This is very clear. And those who supply goods to the company, because of the size of the company, they are not in a position to demand, immediate payment. And this is why the company takes advantage and it has large accounts payable. It is not as if Colgate-Palmolive does not have cash. It can easily repay this. Not a problem at all. It has, even in this year, look at the balance sheet. It has cash and bank it's such a high figure. It's very easy for them to repay. But they are not doing that. They are holding a very large amount in payable. What this tells you is that this company has the power to take credit from the market because of its reputation, because of its size. Why is this happening? If any of the people who are supplying goods to Colgate-Palmolive and are not receiving money, suppose they make this an issue and they begin to say that, no, we want our money, pay us. It is possible that Colgate-Palmolive can threaten, okay, fine, I'll pay you right now. Here, take your money. But from tomorrow, you don't supply it to us. We will find another supplier. We will take from him. And there will be 51 suppliers who will be willing to come and basically supply goods to Colgate-Palmolive because they feel they will get bulk orders, they will get good business. So when you see that a company has very high accounts payable, and at the same time, you see that it has so much money in the bank, you have to relate these things. You can very easily come to the conclusion that this company has a lot of market power. That this is market power. The ability to arm twist people to sell you stuff on credit, to give you goods on credit. And this happens with all the big companies. As a banker, I used to see this happening in Jharkhand. People would supply to Tata Steel, Tata Motors, all the companies which were there. And they would not be repaid in less than 6 months. Tata would accept the bills, but it would say we will pay after 6 months. And that is the same thing is happening with this company. What is the commonality between Colgate, Palmolive and Tata? They are in different industries, but both are giants. Both are very big. Both have a lot of market power. And that is why they are actually able to do this. Now, this discussion that we are having, this is being made possible because we took these figures, converted them into a common size thing, and then tried to analyze. So this is the advantage of using a common size method to study a company. And this is why I thought when I'm giving you a snapshot of accounting, I should also give you a shot of this. You know what this is all about. So you get an idea now about what common size is?
Yes, sir. So these percentages will be there in the sheet, or we need to
No, this has to be calculated.
Okay.
This has to be calculated. It's a very simple calculation.
Yeah, it's simple calculation.
But you will have to calculate. This will not be shown by the
companies
anywhere. Company is only obliged to give the raw data. That means the balance sheet, profit and loss account, and the cash flow statement. You can use that data for and show it
analysis
to you in different ways.
Analysis purpose and
that you can do. There's no problem. Okay. Now, in the income statement also, the same thing is done for each item. In this case, you are using the percentage, the base is the sales figure. So if I look at this, other income, 499, cost of goods sold, 12,501. Total sales is 31,638. Gross profit is 19,636. Now, if I look at the percentages, start with cost of goods sold. So, cost of goods sold is like, how much did it cost the company to produce the goods that were sold? So the goods that were sold for this amount, 31,638, it cost the company 12,501 million to produce. These are all expenses directly incurred on the production of the goods. What will it include? It will include stuff like raw material. It will include factory overheads. Everything. It will include wages which are related to the actual production of the good, that part of it. Every other expense, as we saw in the profit and loss statement, will appear in the operating expenses. But the expenses which are directly related to the production of the goods, that part is shown here. So if we say that part is 12,501, as a percentage of the sales, this is 39.51%. Okay. So my gross profit is 62.06% of my sales. This, Dheerajji, remember, is an actual figure. In this year, this was the gross profit level of Colgate Palmolive. So the sales they were making, 62.06% is profit. Cost of goods sold 39%, other income 499, 1.5% is other income. What this other income is, for that we will have to get into the balance sheet, look at the details of the company, only then we'll find out what that is. On a comparative basis, if I look, I can immediately see that the cost of goods as a percentage of the sales has gone up from between 12 and 13. Used to be 33%. It has gone up to 39%. The profit margin used to be even higher in 2012. It was 68.69%. It has gone up to 62.06%.
It has gone down.
Sorry, it has gone down to 62.06%. Now, so when you look at it like this, you begin to see that something has happened here, which has led to a reduction in the, it is still very healthy. That is a different point. But there is a reduction. Now, if I look at the expense side, here if I look, what I see is that administrative expenses, they account for almost 40% of the total expenses of the company. In the previous year, these admin expenses were even higher, 45%. The profit before depreciation, interest, and tax used to be 6,293, which was 23%. So even though the figure has gone up to 7,080, in percentage terms, this is again less. This is less than last year. Last year, the profit before depreciation, interest, and tax was 23.37%. But this year, it has gone up to 22.38%. Gone down, sorry, to 23%. Interest has also gone down, which is a good thing. Depreciation in this 2012 was higher at 5.27%. Depreciation this year as a percentage of the total expenses is less. Tax as a percentage was much higher in the previous year because they made more profit. Probably that could be one reason. Or maybe there were some other reasons here. This year, tax by comparison is less. Now, at the end, we find a very, something which is interesting. Their net profit has actually gone up. So, in percentage terms, if we looked, it appeared that their gross profit as a percentage has come down. But when we look at the profit after tax, this has actually gone up from 3,400 to 4,968. In percentage terms, it has increased. So somewhere down the line, you can see that they have managed to reduce their operating expenses. And it appears that in percentage terms, at least, the reduction has come here in the sales, general, and admin expenses. This is one place where probably it has come. Now, to understand this more completely, we'll have to get into more detail. But as a snapshot, we are getting an idea about what has happened with their different margins. The gross profit margin, the net profit margin, all that is very clear. So, all income items are shown as a percentage of total sales. So that's that. Now, this is again another example. We don't have to do this now in class. So this is again an actual company, Marico. You can think of Parachute Oil. This is the maker of that, Marico Limited. You can have a look at their balance sheets also, and you can also see what exactly is happening here. If you compare these, if you look at the common size, it will give you a much better idea about what has happened. So these are some more statements from there. Now, this is just to show you how you can compare different companies. So Colgate-Palmolive and Marico are both FMCG companies. Their size is absolutely different. If you want to compare these two companies, we can compare the percentages. See, this is a common unit. The size of the companies, Colgate-Palmolive is much bigger. So the profit numbers will, in absolute terms, will be much, much more than Marico. But if we look in percentage terms, we are leveling the playing field. We are looking at it in the same unit. So if I look at, let's say, the percentage of cash in the bank, you can see it very clearly here. In Colgate-Palmolive, it is 32.82%. In the case of Marico, it is only 7%. You can see how this is a cash-rich company. So you just look at it in the percentage terms, suddenly it begins to become much, much more clear for you. Now, if you look at accounts receivable is almost the same percentage. Loans and advances, almost the same percentage for both. Inventories, you can see that Marico is carrying a much higher percentage of inventory. So a lot of the money of funds of Marico are getting tied up with their inventories. Colgate-Palmolive, much less, 14.18%, 23.27% here. Fixed assets, these things are of less importance that way, as far as understanding is concerned. But this gives you a very good idea of what is happening. Now, liability side, if you look, like I was telling you, this Colgate-Palmolive is a company with huge market power. And I said as an example that accounts payable, they take a very long time to pay back the people from whom they buy goods. And they have a 35%, it is accounts for 35% of their total liabilities. But if you look at Marico, they don't have that sort of market power like this company. It is a more reasonable 12.91%. So what happens is the moment we take different companies, you can take them from different industries also, it is possible to compare their financial performance very easily if we use common size balance sheets. Main message to you here is this. Use common size, everything is reduced to the same unit, that unit is percentage, and then you can very easily see how to do these things. You have a similar comparison between the two as far as the income statement is concerned. And see, if we don't look at anything else, if you just look at gross profit and profit after tax, that itself will give you a very, very clear idea about how these two companies are different. So, for example, the gross profit percentage for Marico is 44.45, whereas it is 62.06% for Colgate-Palmolive. And profit after tax, 15.70% for Colgate-Palmolive, but only 8.61% for Marico. So the moment you begin to look at it in percentage terms, you begin to read and analyze the balance sheets much more clearly. So basically, if you have understood this much, this sort of empowers you to conduct some very basic analysis on balance sheets of different companies. You can try this with any public sector company. Not public sector, sorry, publicly listed company, where it's very easy to get their financial statements. And you might even enjoy doing the exercise because you will see how these little tips which we have just discussed will help you to actually understand those figures better. And then as you go ahead with it, you will become more expert yourself in looking at this. Okay. Now, there are, connections between the items in the income statement and the items in the balance sheet. So that it's also interesting to look at this. So look at this, total sales. There is a relation between total sales and cash and bank. So these are things now which you will have to see. Now, other income is directly related to other assets, because the other income comes from investments made by the company, which is shown in the other asset column. And the other income will also affect the cash and bank. Because ultimately, the income, whether it comes from the business or whether it comes from the non-business parts of the investments of the company, it will ultimately enter the bank account. Now, the total sales should also be compared with the accounts receivable, because it shows you that this is total sales. This, because you are selling goods on credit, that is why you are getting an accounts receivable. So there is a relationship between sales and the amount of goods sold on credit. So these two again they are linked. Now look at this one. Loans and advances. You have made investments in other companies. You have given loans to other companies. That loan and advance is reflecting in your other income. Just like other assets, investments made by you are reflecting here. Similarly, loans and advances will also reflect in other income. And the other income will reflect in the cash and bank. So, in this way, you can see how these keep getting linked with each other. Now you look at this. The cost of goods sold is directly related to the accounts payable. Why? Because the cost of goods sold depends on the raw material purchases, what has been purchased from suppliers. And whatever has been purchased from suppliers, the more you purchase, if everything is going well, the more you will produce. This figure will change. And the more you purchase on credit, the more this figure will change. Accounts payable. So this and this are again two items, one from the balance sheet side, one from the profit and loss side, which are linked. Now here is another one. Sales, general and admin expenses. This is normally linked with other current liabilities and provisions. Not a very interesting item, but just for your understanding, these two are again linked. Interest is always related to loans, long-term liabilities. Remember, loans are liabilities. So, sources of funds, the more loans you take, the more interest you pay. So, there is a direct link here. Fixed assets will decide the amount of depreciation. Because the depreciation that you charge are on the fixed assets that you have. So fixed assets will determine the amount of depreciation. So that was just an idea to show you exactly what happens, how these two things are actually related. Now there is another way of analyzing one company. See, when we looked at common size, the intention was to analyze not just one company, but to have a comparison between one company and another company, to compare them. But in index-based analysis, what we do here is that the performance of the company is seen in comparison with its performance in a particular base year. So I take one base year, let's say I take 2011 as a base year. Everything that happened after 2011, I compare with 2011. Just as an example, you take one base year. Let's say in that year, you install new machines. And then you begin to see after the installation of machines, what happened to the performance of the company. So some event of importance to the company may have occurred in this base year, and the company management wants to see the performance of the company as compared to the performance in that base year. Let's say you spent a lot of money on new software. You did some great investment in inventory management. You spent a lot of money. Now you want to see, does the inventory management work reflect positively in the financial results after this software was installed? So the year in which the inventory management software was actually put into place, was implemented in your company, that is the base year. And after that, everything else, everything that happens after that will be compared with the performance in the base year. So if your decision was correct, and if the software, the decision to install the software was correct and the software did well, then that should reflect in your financial performance. This is the basis. Now, for example, a company may have modernized its machinery in 2011. So up to 2010, the company was manufacturing its products based on its old machines. After 2011, it brought in new machines, and it is expected that the performance will improve after 2010. Okay, so 2010 becomes the base year, because up to 2010, they are still using old machines. Old machines, maybe the products which are produced are not as good in quality. Maybe the amount of efficiencies are different. With new machines, maybe you get a better output with the same level of input. There may be many reasons here. Now, 2000 becomes the base year, and the item-wise performance of the company in 11, 12, 13, etc. can be seen as compared with 2010. So if the modernization of machinery has actually helped to achieve something, it should reflect in the results of the company in the subsequent years. This is the logic. Now, another example can be that in 2011, the CEO of the company changed. You see, top management changed. Now, the owners of the company want to see whether the change of this guy, this person, actually is helping the company or not. Maybe they have brought in a new CEO, they are paying him a huge salary, they are giving him stock options, giving him bonuses. Now they want to see if by bringing this man, what actually happened to performance. Let us see it as a percentage of the base year when this man was not there. So, there can be many reasons for using this. For example, let's say that in 2010, in the case of Colgate-Palmolive, some event has happened, which is of very great importance. Using this as the base year, I want to compare its performance, the same company's performance, in the next 3 financial years. So these are the raw figures. In 2010, the base year, the total assets was 8,828. This was the breakup. What happened in 2011? What happened in 12? What happened in 13? Now, if I don't put this in percentage, analyzing this quickly is a problem. But if I use the index-based technique, it becomes like this. My FY 2010 is my base year, so I treat it as 100. Everything else is as a percentage of this. So what did we see here? Cash and bank was 3,476. Cash and bank was 3,951 in 2011. Now, if I reduce it to percentage, I immediately see that this has gone up by 14%, from 100 to 14. In 12, it has actually gone down in percentage terms. And in 13, it has gone up by 23%. So if in this year, I took some step which was of great importance. How did it affect my cash balance in the coming years? How did it affect my accounts receivable? How did it change my investments? What happened to my inventory management? Did it improve or did it disimprove? What happened to fixed assets, other assets, total assets? So by doing this, you are able to actually understand whether the company is actually moving in the right direction after the changes it made here. Now, so this index-based analysis, remember, this is just an example. This slide, these examples that I have given you here, how a base year is chosen, please remember this properly. Now, if you know, let's say you know of some company, let's say in which you have invested in shares, in which there is some interest you are taking, and you know that some big event has taken place. You remember a few years back, Infosys, there was a change in the CEO. Now, if you want to actually check whether after the change in the CEO, did Infosys actually do better after that? You can use this method. All the figures are available. You can use this method to actually make a index-based analysis of Infosys. So first we did profit and loss, balance sheet, cash flow. You understand the basics there. Third, next, we looked at common size. So you see how that can help you. And now you have this index-based analysis. So with all these tools, you begin to understand how you can extract more from the same figures. So the raw data is easily available. I have these tools at my disposal. I can use these tools to effectively understand how these things work. So then the last part of this discussion relates to financial ratios. So when we talk about financial ratios, what are these? These establish relationships between different items of the balance sheet and profit and loss account. Remember, in one of the earlier slides, we had seen how the different items are related, interrelated. Balance sheet, profit and loss. Remember, in your mind, you should be clear, balance sheet is my investment side. Profit and loss is the results. When I begin my business, I create a certain business, it reflects in my balance sheet. Where did I get my money from? How did I invest the money? These two questions are answered through your balance sheet. But what the profit and loss tells you is, how did I perform? Did I do well or did I not perform as per my potential? Therefore, when I begin to compare items in the balance sheet with the performance let's say the items in the profit and loss, I begin to see how successful I have been or how, or whether it has actually been so much wasted effort and I have failed. Now, many items do not have any meaning when seen in isolation. They become meaningful when related to the base figure. For example, profit on its own has little meaning. But when we compare it with the sales figure, we can take a view. If I tell you that, let's say this company has 4,000 crores of profit, you will say, okay, it's good. And I tell you there's another company which also has 4,000 crores of profit. You may say it's equally good. But if I suddenly find that the first company has 4,000 crores on the basis of a very huge sales figure, which means that let's say it has a sales of 40,000 crores and it is making a profit of 4,000, which basically means that its profit is just 10% of the sales. But the other company with 4,000, it is managing to make this out of only 8,000 sales. So a ratio like that, relating the sales with the profit, will give you a very good idea about how efficient your company is in basically doing its business. So this is one example, the one I was giving you. The profit of 100 against sales of 1,000 is 10%. A profit of 100 against sales of 2,000 is 5%. But in both cases, the profit is 100 only. But because of this ratio, once I make this comparison between these two items, so you just need to know which items are interrelated and which items to compare. Once you get that, it becomes very easy. Then it's simple arithmetic. So if you look at it like this, sales or revenue, gross profit, owner's equity, PAT. This sales or revenue should be compared with the gross profit to see the relationship. What percentage is this of this? What percentage is this of this? What percentage is this of this? What percentage is PAT of owner's equity? Now we are introducing a balance sheet item. So these the size of these different circles, as you see, is getting progressively smaller. The sales figure remains the same. These begin to get smaller. Naturally, the gross operating profit will be less than the gross profit. Similarly, the net profit will be less than the operating profit. So these things, this is just a pictorial way of showing you that there are relationships here. Now, let us look at some standard ratios. When we look at profitability ratios, the first thing you consider is the margin on sales. What is the gross profit margin? What is the net profit margin? What is the operating profit margin? First thing is to just check this with sales. The moment you do this, you will begin. So what are the two items I'm comparing? Sales and different profits that I have. Now, return on investment, you have invested money. So operating profit to operating assets. What are the operating assets? The equipment, machinery, those are the main assets which are actually generating revenue. So the revenue is coming here. The operating assets are here. Return on total assets. Return is always profit after tax. Whenever you see the word return here, you are going to think about profit after tax. That is the money which actually remains with the company at the end of the day. Return on equity. The profit after tax as compared with the total shareholders' funds. In total assets, I am looking at shareholders' funds as well as the amounts which I have borrowed. Because the total assets that I have created on the basis of funds that I received, not only from my shareholders, but also the funds that I received from my bank, for example, from my bondholders, from whom I borrowed money. So I look at that. Then I look at efficiency in the use of the assets. How do I look at this? Total asset turnover. So the sales figure in a company which is like a trading concern, it will give you a good idea about how much it has managed to actually sell. Operating asset turnover, working capital turnover, how many times was the working capital rotated, and return per share of equity. This is for shareholders, earnings per share. So anybody, if you have made any investment in any company and you are tracking that company, one of the things as a shareholder which you should track is the earnings per share. Earnings, once again, is profit after tax. So these words now are all interchangeable. Return, earnings, profit after tax, same thing. Talking about the same thing, it just presented differently. Dividends per share. This is another thing which a shareholder will want to know. Dividend payout ratio. Payout ratio is simply the amount out of the profits that were earned, what percentage was paid out as dividends. So if it could be like 100 rupees was made as profit, 50 was given as dividend, 50 was retained in the company for further investment. That can be another way. Then you can look at the short-term solvency position. Solvency is the financial health of the company. So how do we look at this? Current ratio. So current ratio is relating two things. We look at this in the current assets and the current liabilities. So the current assets are basically cash in the bank, your receivables. These are the two main heads. In the current liability side, what you have received from your suppliers on credit, that is the main head. So you compare these two, which will show you whether you are in trouble in the immediate future or you are comfortable. Average daily expenses, cash cover for daily expenses. These are explained in detail in the next few slides. Then you have operating cycle activities, accounts receivable turnover, okay, average collection period, inventory turnover, inventory conversion period. Finally, average payables period. Just take some of these, which will give you an idea. Accounts receivable turnover is basically during the course of the year, you sold goods on credit. When you produced, you sold them on credit. How long on an average, or see, the money came back to you, you produced goods again, you again sold. So how many times did it turn over? And how many times were you able to receive the money, use it, create fresh debtors, and again receive the money from them? What this will tell you is that if your money is stuck with some people and they are not paying, then this turnover is going to be very low. You have paid money, you have given goods to someone, they are supposed to repay you the money, they are not repaying you on time, it is gradually becoming a bad debt, in which case funds for you are blocked and you are not being able to repay again. So this is going to create trouble for you. So this is one. And then long-term solvency position, total debt to total capital. This is easier to understand. So out of the funds that you have, what is the proportion between debt and capital? One, long-term debt to total capital. So debt, in the earlier discussions, if you look at the earlier presentations that I have sent to you, you'll find that there is a distinction between long-term debt and short-term debt. So basically, up to 1 year is short-term debt. Anything above 1 year is long-term debt. So long-term debt to total capital. Total capital is comprised of the shareholders' funds plus the borrowings. So if I just take the long-term component, what is the proportion between the long-term component and the total capital? The interest cover is basically the relationship between the interest and the borrowings and the profit and the equity multiplier. Now, if I look at for each of these different ratios that I showed you, I have tried to show it to you in the statement itself. So one of the ratios we spoke about is gross profit. So gross profit is sales minus cost of goods sold, total sales here. And from this, I'm minusing the cost of goods sold, which is here. Gross profit margin will be gross profit divided by sales. So in this particular case, the gross profit is this. The sales figure is here. You can calculate the gross profit margin very easily. So when different products are sold, the gross profit margin is the overall profit on all products put together. This surplus is obtained over the input costs and reflects the efficiency of the use of the direct inputs. Just a small explanation. Operating profit margin equals operating profit to sales. This reflects the profitability of the operations of the company. Remember in the example which I had shown you, the one which was not from a listed company, which I had made myself right in the beginning of this presentation, we saw that there is a distinction between the operating profit and the non-operating income. So when you make investments in other companies, or you sell land or something like that, then you are basically making a non-operating profit. So what the operating profit basically does is, it tells you about the relationship between operating profit and sales. That means what is the actual profit the business is making from its own operations. You are not concerned with the investments made by you. This is one slide here. Margins of sales continued, net profit margin. Profit after tax to sales. This is the profit available to shareholders. This is influenced by operating efficiency, financing costs, and taxation. So net profit margin is useful when we want to compare different companies. So see, many of these things, these relationships, you will find if you do the common size analysis, some of these you will find it is already there. Because you have reduced things to percentages, this net profit margin or the other margin, the gross profit margin, those will appear immediately. Now, return on investment, operating profit to operating assets. So these are the three. So profitability does not exist in a vacuum. It is judged on the basis of the amount of resources. The point we were making earlier. Excuse me. The performance of management has to be evaluated on how successful they have been on profitably utilizing the assets. For the assets have to be related to profit earned. So if you want to see how efficient your management is, you look at the profit margins. They have taken money from shareholders, from their bankers, from bondholders, and they have invested it in the company. Now, after all this investment, what is the amount of profit that they are actually making? This is what you have to find out. So operating profit to operating assets. Operating assets are the current assets and the fixed assets in use. So both figures are there in the balance sheet. So if you take these, you will get the entire amount. But you should remove the cash and bank balances. In the current assets, you will find that the cash and bank balances are also there. But since the cash and bank balances have not been used in the production process, therefore you remove this. You look at the other assets, and then you relate this to your operating profit. Yeah, it's actually quite a lot to take in, Dheeraj, in one lecture. But
yes, sir.
So what I will do is, we will end it here. You have very patiently listened for 2 hours. And then I will send these to you.
Yes, sir.
What I will do is, I will send this to you. have a look at this over the next 7 days. When we meet again on Saturday, let's try to discuss this further.
Okay, sir. I will.
So I think today I'll end here and I'll send these to you and we can discuss it. Thank you so much. You have been
very
patient and very attentive in class. And
no, sir. Actually, I missed some classes last week also, so I need to cope up on that.
Okay. And if you want my assistance at any point, it is always a pleasure for me to communicate these things. This is not a financial thing for me. Let us be clear here. If I can pass on some of my knowledge to you and if you become better for it, that is something which will give me a lot of pleasure. I was able to help.
I will go through it, sir. And then if anything, I will. Yeah, okay, sir. For sure.
Right. Okay,
Thank
then.
You, sir.
Bye then. And I'll send these and we'll again discuss this next time.
Okay, sir.